Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and we're excited to have you join us today. As we start this new episode, let's take a look at some recent predictions from Tom Lee, a well-known Ethereum bull. According to a report on Benzinga, Lee is predicting a 10–15% downside for stocks in early 2026. This forecast is based on his analysis of market trends and historical data. However, it's essential to note that predictions are never certain, and the stock market can be highly unpredictable. On the other hand, Lee remains optimistic about the future of cryptocurrency, stating that the best years for crypto are yet to come. This sentiment is shared by many experts in the field, who believe that blockchain technology and digital assets have the potential to revolutionize various industries. To succeed in the world of investing, it's crucial to develop smart habits that can help you navigate market volatility and achieve long-term wealth. According to financial experts at Fidelity, successful investors prioritize saving over spending, diversify their portfolios, minimize investment costs, and regularly review and rebalance their holdings. In fact, a recent article on geo-banking rates highlights 6 habits of successful investors, including staying the course during market downturns, prioritizing saving, diversifying your portfolio, minimizing investment costs, reviewing and rebalancing regularly, and avoiding emotional decision-making. As we continue to explore the world of stocks and finance, it's essential to remember that investing always involves risk. However, by being informed, disciplined, and patient, you can increase your chances of achieving your financial goals. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of finance and technology, and today we have a fascinating story to share with you. Our middle segment takes us to the realm of e-commerce and artificial intelligence, where Chinese giant Alibaba is making waves. Alibaba's stock recently took a hit due to disappointing Chinese economic data, with retail sales rising only 1.3% in November. This slowdown has raised concerns about consumer spending in the world's second-largest economy. However, Wall Street remains bullish on Alibaba's long-term prospects, and the company has been quietly emerging as one of China's most advanced AI players under CEO Eddie Wu's leadership. Alibaba's Cloud Intelligence Group posted impressive 34% revenue growth last quarter, with AI-related product sales up triple digits for the 9th consecutive quarter. The company's Qwen large language model is competing directly with other industry leaders, and Alibaba has gained significant market share through aggressive price cuts. This positions Alibaba as a key player in the US-China AI arms race, where Beijing aims for global dominance by 2030. Beyond AI, Alibaba is battling JD.com and Meituan for China's instant commerce market, potentially worth $500 billion by the decade's end. The company delivered robust third-quarter results, with total revenue climbing 15% year-over-year to RMB 247.8 billion. The quick commerce business emerged as a major growth driver, with revenue soaring 60% as the company executed aggressive expansion plans. So, is Alibaba's stock undervalued? Analysts forecast revenue to increase from $138 billion in fiscal 2025 to $217.44 billion in fiscal 2030, with free cash flow expanding from $10.25 billion to $28.26 billion. If priced at 20 times forward FCF, the stock could gain 70% within the next 4 years. With 20 out of 23 analysts recommending a strong buy, it's clear that there's optimism about Alibaba's future. As we consider the intersection of e-commerce and AI, it's essential to weigh both the opportunities and challenges. While Alibaba faces intense competition and regulatory scrutiny, its strategic investments in AI and quick commerce position the company for long-term growth. As investors, it's crucial to stay informed and adapt to the evolving landscape. Welcome back to the Riskwiser Zone. Today, we've been exploring the intricacies of the tech industry and its impact on our investment portfolios. As we wrap up this episode, let's take a closer look at Western Digital, a company that's been making waves in the data storage sector. Western Digital's recent inclusion in the Nasdaq 100 index has sparked significant interest among investors, and for good reason. The company's transformation into a focused provider of high-capacity storage for the AI economy has positioned it for long-term success. With a 107% rally over the past 12 months, one might think that Western Digital's stock is due for a correction. However, many analysts argue that the company remains attractively valued, trading at a discount to its peers. The demand for data storage is skyrocketing, driven by the rapid growth of artificial intelligence and cloud computing. Western Digital is well positioned to capitalize on this trend, with a strong presence in both hard disk and enterprise flash storage markets. The company's revenue growth has outpaced the sector median by 8.3 times, with 75% revenue growth driven by AI-driven demand. While some may argue that Western Digital's stock is overvalued given its recent surge, others see significant upside potential. With a price target of $218, implying 24% upside potential over the next year, it's clear that many analysts believe Western Digital has room to run. As with any investment, it's essential to approach Western Digital stock with caution. The tech industry is notoriously unpredictable, and even the most promising companies can face unexpected challenges. However, for investors looking to capitalize on the growing demand for data storage, Western Digital is certainly worth considering. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.